Let's start from the history of venture capital, where it all started and how it evolved in the last 3 or 4 decades, and how we got to the place that we are right now. Now, whenever someone takes the word venture capital or VC, the first thing that comes to our mind is, of course, Silicon Valley, or the network or the culture of Silicon Valley that started around the time of 1960s. But the core principles of venture capital, they have been around for centuries. The human desire to fund, to provide capital for innovation, that has never changed. That has been around for centuries. But what actually changed was how we organized and how we professionalized the whole funding part. So if we try to go back in history, the earliest form of venture capital, they started in the era of whaling industry during 19th century England. The captains of the ship, they needed funding for long and risky voyages that could take years, and it might return something, it might return some profit, or it might return nothing, right? There is that risk of starting something unknown, going into an unknown adventure, and you might get a profit and you might get a loss. So wealthy merchants, people who had a lot of money in cities like Boston and New Bedford, they would fund these expeditions in exchange for a share of those profits, if those profits happen. This whole arrangement, if we look at it, it had all the key elements of the modern venture capital. First, there was high risk and also high potential return, right? There was high risk and also high potential return. The funders, the wealthy people, they not only just provided money or capital, they also provided expertise and information about the markets, about the operations, because you might be a new ship captain, you might be going on your very first expedition. But these funders, these wealthy people, they have been doing this for a long time, maybe generations. And they have experience navigating these markets. They have experience how to not do certain things to avoid losses, how to be safe, and how to optimize for the maximum amount of profit. They of course have the money, but also a lot of other valuable stuff like expertise in certain markets and their experience. But the most important part is these funders, these wealthy people, they understood that many of these ventures, many of these ships that go in expeditions, they would fail completely. Either they will never return, or either their ship will crash in the ocean or whatever, some kind of tragedy, or they might just come back without making any kind of profit. But the successful ones, they need to generate returns large enough to cover all the losses plus provide some extra profit, right? So imagine these are the wealthy people. They have come together and they have arranged some amount of money to provide to ships. Now, some ships sailed and went on different expeditions. Sorry for my drawing, but you get the idea. And let's say after around, let's say take the average of 5 years. After 5 years, only 2 ships returned. And one of the ships, it just made enough profit to break even. Right? Whatever money the funder had invested, it got the same amount of money and little extra, which cannot be considered a profit. But one of the ships, it came across some kind of treasury, right? Some kind of insane amount of wealth under the ocean or something like that, right? So this made up for all these ships that sailed but never returned, or returned with loss or just limited amount of profit. But one of the ship, it came across treasure, and it made up for all the other ships plus more profit on top of that, right? That is the core idea of venture capital business. This whole whaling industry, it taught some important lessons to the American capitalists that we still follow after centuries. The first thing is diversification matters. No single merchant would fund just one ship. They would spread all their investments in different ships, in different voyages, and voyages which are covering different parts of the world. They will not cover just a ship, or they will not cover 10 ships going to a certain part of the world, to a certain island, to a certain country. They will try to fund ships. They will try to fund voyages which are going first. They will try to fund multiple ships. And the second is they will try to fund ships which are going in different directions. They are covering different parts of the world, or they are carrying different goods in the ships, or different kinds of businesses. The whole idea is diversification, so that not all your eggs are in the single basket. That's the whole point that we are trying to make here. And the second thing is expertise adds value. The most successful funders, the people who gave money to ship captains, the most successful ones, they did not just give the money and sit back and waited for their profits. They were not passive investors. They provided guidance and expertise on a variety of stuff, from market information to crew selection to the timing of the market, the timing of the voyage, and a lot of different things. By the mid 1800s, this whole model of funders and ship captains, this whaling industry, this began appearing in other industries also. For example, one of a few industries are railroads or mining or manufacturing. All these different companies in different industries, they all relied on similar kind of arrangements. This was the mid 1800s, where this whole funding practice spread into different industries like railroad, mining, manufacturing, and of course it was in the whaling industry in the first place. By the late 1800s, in the later part of the century, a lot of investment banks, they started showing up. Investment firms like JP Morgan and company, they began not just lending money, but also taking equity or shares from companies that they financed, or the companies that they gave money to. In exchange for the money they gave to the companies, they took some part of the company, some ownership of the company. Right? We'll discuss a lot about this equity stuff in the later videos, but for now you can understand that equity basically means you are taking some ownership of the company, which at a later point of time, if it is profitable for you, then you can sell it off and make some amount of profit. Now, these investment banks like JP Morgan and company, they innovated a couple of practices while they were financing these companies. And these practices are still used in the whole venture capital ecosystem. For example, one of them was due diligence. Due diligence basically means that before you give money to a certain company, you are an investment bank or you are a venture capital, before you fund a particular company, before you start investing, you do some careful examination of the financial health and other prospects like other potential investments, competitions, the market, and a lot of factors that comes into due diligence. Due diligence itself has a lot of other procedures, sub procedures under it. On a high level, all the different kind of research that a investor does before investing in a certain company, we call it usually due diligence. The second thing, board seats. These investment banks during the late 18th century, in exchange for investing some amount of money in a certain company, they took board seats. What does board seat mean? Now, companies have this entity called a board, which is responsible for primarily for advising the CEO and helping the CEO, guiding the CEO. But independently also, the board has the responsibility to make sure the company runs, to make sure the company's operations are intact, the company is making profit, etc. Right? For the company's benefit and for the CEO's benefit. So a board is constructed primarily when the company is starting out. The board is usually consisted of the founders, but eventually as more and more venture capitalists and growth stage funds and private equity, depending on how far you are going in your whole funding life cycle, more and more board seats are given to the investors, the lead investors. So this also started during the late 18th century era when investment banks like JP Morgan was investing or financing companies. So this practice has also been for a long time. Now, this investment banking model, it of course has a lot of similar points to modern venture capital, but it also differs from the modern venture capital ecosystem in a lot of different ways. One of the ways is most of their investments of these investment banks, they went to established companies which has a business established, which is already making profit, which already has a market, but they need the funds, the money for some reason, for growth, for expansion into other territories, for financing some immediate scaling operation. There could be a lot of reasons. And the second thing is they also focused heavily on traditional industries like railroads, steel, oil, rather than the bleeding edge technologies like the modern venture capital does, betting on the future. That these traditional investment banks never did. They played safe, they invested in traditional companies, and that also established traditional companies. The amount of money involved was much, much larger, and the investment period was smaller. The average venture capital investment period, if you look at it, before an exit happens. Exit basically means either the company goes for IPO, goes public, or it gets acquired by some other big company, right? These are the primarily two kind of exit options that VCs look for, and that mostly gets accounted for, right? So the point is, an average duration before a VC starts investing in a company and the company gets an exit, or the VC gets an exit, it mostly will average around 7 to 8 years. And sometimes it can go to 12, 14 years, etc. Right? 14 years. But these traditional investment banks, they had very short investment periods, like 2, 3 years, max to max. But the organizational benefits are still there and still followed. These investment banks, they created the first systematic approaches to evaluate things like risk and returns. They also developed standardized legal structures for equity investments, and they also built networks that could quickly mobilize large amounts of capital when some opportunities showed up. Okay, now advancing through it, we reach the early 1900s. So far, we've been talking about the 19th century, which means 1800s to the start of 1900s. Now, during the early part of 1900s, we had a couple of investments that is the most similar when we are talking about the modern venture capital, because this is the time when new technologies like electricity, automobiles, and radio started getting invented, and entrepreneurs, they needed capital to commercialize their innovation, to make their innovations, make their inventions reach the mass audience. Some of the earliest technology venture investments that happened during the time of Thomas Edison, inventor of light bulb, if you know. During the time of 1878, a group of wealthy individuals, people with a lot of money, including the investment bank that we talked about, JP Morgan and Company, they formed what is known as Edison Electric Light Company to commercialize the Edison's invented bulb, light bulb. Now, this has a lot of similarities if you look at the modern venture capital, because the technology, the light bulb technology, which was very newly invented, which was unproven, not had a market, and even if it had a market, the market was uncertain. And for this to get success, the invention was not enough. It needed building an entire industry infrastructure. Similarly, the automobile industry also had similar patterns. Early car companies like Ford Motor Company, they relied on wealthy individuals who were willing to bet on an unproven technology which was trying to disrupt the established transportation methods. Henry Ford, the founder of the Ford Motor Company, his initial funding came from a group of Detroit businessmen who provided money. Of course, they provided capital, but they also provided the market expertise for transportation. Similarly, if we talk about radio technology, it also created a wave of venture capital investments. Companies like Radio Corporation of America, RCA, that was funded by a group of investors who understood they were betting on entirely new industries and which might exist in a few years and it might not. So if you look at all these historical examples of investments, people funding new inventions and uncharted markets, they established a lot of important precedents. Next comes the World War II. Now, World War II created a massive acceleration in technology development, and it also established new relationships between government and universities and private industries. And this was the final period which set the stage for the formal creation of venture capitalism that as we know it today. Because of the war, it was proven that with enough research, with enough systematic research and capital, we could produce breakthrough technologies. Because if you look at history, radar, jet engines, computers, the whole concept of internet, nuclear technology, all of this started from government funded research programs. And when the war ended, many scientists and engineers, they wanted to continue this innovation, but in private companies rather than government labs. And finally, we reach Silicon Valley. Silicon Valley during the time of 1960 to 70, right, which is formally known as the time when venture capital became the standard. But let's talk about why it happened and why it happened during that time and why it happened in Silicon Valley. Why Silicon Valley is known as the hub of technology, is known as the hub of venture capital that we know today. What were the factors? One of the first and one of the most important factor was Stanford University. Now, Stanford University played a very central role, both through its research programs and also its business friendly policies. Unlike many of the universities during that time, Stanford allowed and also encouraged professors to consult for private companies, even start their own ventures, their own businesses. So that was a very big boost. Second thing was defense spending. The Pentagon's need for advanced electronics, computers, and aerospace technology, it created enough customers that were willing to pay premium prices for cutting edge technologies. Now, this whole factor, this gave startups revenue opportunities, which was enough to support growth without requiring a massive consumer market penetration, because defense created enough customers in itself so that startups could serve those customers and generate enough revenue without trying to get into the mass consumers. Third is semiconductor technology. Now, this particular industry, for some reasons, it proved to be the perfect industry for venture capital because semiconductor companies, they required a lot of upfront investment, a lot of upfront capital for both research so that they can constantly improve, they can constantly come up with new ways of improving their chips, and also manufacturing equipment, manufacturing chips in general. The whole semiconductor technology, it evolved pretty rapidly and it created a lot of opportunities for new companies to compete with the established players. So that market was always moving, always new companies were rising and trying to beat the existing ones. So if you got success as a semiconductor companies, you would make enormous returns. But if you failed, that is completely common and expected. And because of that, a lot of companies emerged in the semiconductor industry. That is the reason and encouragement for a lot of VC funds also started to show. And since we are talking about semiconductor technology, one of the key events of the history, at least when we are talking about the VC industry, is the story of Fairchild Semiconductor Company. Now in 1957, 8 engineers, they left Shockley Semiconductor Laboratory to start Fairchild Semiconductor Company with the support of 2 companies called Fairchild Camera and Instrument Corporation. Now, Fairchild Semiconductor, it became enormously successful. But more importantly, it became the breeding ground for future entrepreneurs. By the late 1960s, former Fairchild employees, ex-employees of the Fairchild Semiconductor Company, they started dozens of other semiconductor companies after, of course, leaving the company. And some of them have gotten pretty famous. For example, Intel, AMD, and National Semiconductor. Now, this created what is known as Fairchild family tree. Each generation of startups created another generation of experienced entrepreneurs, and early employees left the previous company to start their own companies. Now, finally, during the time of 1970s, this was the time when venture capital, it stopped becoming something which only wealthy individuals could do and started becoming an industry, a formal industry, with specialized firms, professional management, and institutional investors. So during this time, there is a famous person called Arthur Rock. He is mostly known as one of the first professional venture capitalists. Arthur Rock, he had helped finance and invest Fairchild Semiconductor, and later on, he also invested and financed Intel, Apple, and a lot of other technology companies. He established a lot of practices that became the standard that we know today in the venture capital industry, including things like systematic due diligence, active involvement with the portfolio companies, and building networks of entrepreneurs and other investors. Now, second key event was the establishment of the VC firm Kleiner Perkins. Now, this is a very famous and one of the top VC funds of Silicon Valley. They have financed companies like Google, Amazon, Uber, Airbnb, Twitter, Slack, and a lot of other top companies. And one of the recent ones was, at least in the tech community, was they also invested in Bun. Bun, if you are familiar, Bun is a JavaScript runtime. So that is the recent investment that I know of. So this was around the time 1972. This was another milestone in the whole VC business. There were two people, of course. Kleiner Perkins is the joint name. The first one was Eugene Kleiner, and he is known as one of the original Fairchild 8, which means one of the early employees of Fairchild Semiconductor. So previously I said that the company Fairchild Semiconductor, from that point on, a lot of startups, a lot of VC companies emerged, and this was one of them. Eugene Kleiner, he was one of the employees of Fairchild Semiconductor, and the other one was Tom Perkins. Both of them together created this VC firm called Kleiner Perkins, and this became one of the most successful venture capital firms that we know today. Their whole idea, their whole model was Kleiner, who was an engineer in a semiconductor companies, who brought technical expertise, and Tom Perkins, who brought business and finance skills because he had some amount of investment banking experience. Kleiner Perkins was the VC fund, the VC firm which established this concept called partnership structure that became the standard for the venture capital firms. That it's still the standard, which basically means that rather than wealthy individuals, wealthy people, wealthy investors investing their own money, the firm, the VC firm, the venture capital firm, it would raise funds from institutional investors like pension funds and university endowments. University endowments basically means big universities like Stanford, Harvard, and other big universities. They have a particular fund which is mostly donated by other trust funds, other wealthy people, and some amount of charity, etc., which universities are supposed to invest and get some amount of profit and add it back to the fund so that they can sponsor a lot of things like providing scholarships, providing stipend, etc., right? A lot of finance needs of the university. So this firm, this VC firm, the venture capital firm, it would raise funds from institutional investors like life insurance companies, right? Wealth management companies and big wealthy family offices and university endowments who want to invest their money in some way. So they would raise funds from these kinds of investors, and the firm's partners, we call the people who work in a venture capital firm as partners. There are different kinds of partners called general partner, managing partner, etc., that we'll talk about soon in a later video. But the partners, the people who work in a venture capital firm, they would manage this money, they would manage this fund, but in exchange, they'll take two things. One is a management fee, which is typically something from 2 to 2.5%. We'll talk about how we calculate that and how this all number game plays out. But on a high level, we are just talking about what they get, what these firms get in return, in exchange for managing the funds for these institutional investors. Second, they'll get another amount of money, which is called carried interest, which is usually something like 20%. Again, we'll talk about what is carried interest. Now, management fee is something which is fixed, which they take from these institutional investors. Carried interest is taken from the profit from an exit event either from the IPO, or if the startup, the company they invested in, the VC fund invested in, if that company gets acquired by another company, makes some amount of money, then they can take the 20% of that as the carried interest. So this is the standard today that we still follow today in the venture capital business, in the venture capital ecosystem. And Kleiner Perkins was one of the first VC firms which established this standard that we follow today. Now, this particular structure, this particular standard of management fees and taking money from other wealthy individuals and institutional investors and managing the fund for them and taking management fee and carried interest, etc., all this structure, it solved a lot of important problems. First thing is, it allowed the venture capitalist, the VC firm, to invest in much larger amounts of money than they could provide personally. Because of course, if you started out and you asked a couple of your friends how much money do you have, and you added some of your money, then the amount that you can come up with is going to be significantly smaller than if you just went to 3-4 very wealthy people and asked some amount of money from them, right? So you now have a much larger capital to invest in other companies, in other startups. So that is the first problem this particular structure solved. Instead of investing your money, you will take money from other people and invest that. The second thing was diversification, which is also related to the first point, because if you have less money, then you can only invest in, let's say, 1 or 2 companies, right? Maximum. But if you have a larger fund, then you can take that fund and you can invest in a lot of companies at the same time, which is what we mean by diversification. And one of the advantages of diversification is it normalizes the loss and sometimes gives you profit also. So as we saw with the ship example, in the ancient times, 20 ships sailed and only one of them made profit. But since it came across a treasure, it made up for all the other ships which made loss and also gave the funders a fair amount of profit. The same way, VC funds, since they now have a larger amount of capital, they can invest across a lot of companies. And even if pretty much 80% or 95% of them fail or do not make any significant amount of profit, even if only 5% of the companies makes good amount of profit or exceptional amount of profit, 100x or 1000x, then the risk is significantly lower of the VC fund making a loss, and the probability of making a very good profit is much, much higher. Then during the 1980s, another boom happened, which brought venture capital business, the whole ecosystem of venture capital, into mainstream awareness. A lot of people got to know about it, a lot of startups got to know about it, and it started becoming more of a standard. And a lot of factors played a role in this also. And one of the most important factors was the invention of PC, just personal computers. They provided the perfect investment opportunity for venture capital. The PC technology, it required a substantial amount of investment, an upfront investment, both for manufacturing and scaling and expansion of the business globally and successfully. The market of computers was obviously growing rapidly, but established computer companies, they were very slow to adapt to the market demands. And because of that the slowness of the established company to adapt to the market demands, a lot of new companies, a lot of startups that you call, they started to show up, they started to form, and they started competing very ruthlessly with large and well-funded companies. And that in turn created a lot of opportunity for the venture capital industry, for the venture capital business. Some of the companies are companies like Apple, Microsoft, Lotus, etc. Right? They showed that venture-backed companies, venture-backed small startups, venture-backed private companies, they can become enormous public companies in relatively short period. Apple's IPO in 1980, it created more millionaires than any company in history up to that point. Similarly, Microsoft's growth it proved that even software companies could achieve higher returns than hardware companies for the first time. So all these success stories, all these success events of these investments, they attracted massive amounts of capital into these venture funds. More institutional investors, more wealthy people, more family offices, more university endowments, they started pushing more money into the venture funds. So the total amount of venture capital under management that grew from 3 billion in the 1980s to 30 billion in the 1989. In just 9 years, the amount grew from 3 billion to 30 billion. Now, more capital does not always mean it's a good thing. Of course, it is a good thing most of the time, but it can also cause problems. One of the good things is, of course, more capital means venture firms could finance more companies and provide larger funding rounds. But it also meant more competition among venture firms for the best deals among themselves. And in turn, that drove valuations of the company up. And because venture firms were having competitions among them, the valuations of company they were investing in, they went up. So it became a competition. And as a result of higher valuation, it obviously means that lower returns. If you have a lot of expectations, a lot of unrealistic expectation from a company, when it actually returns something, it is obviously going to be disappointing. Right? That is one of the problems of pooling all these resources, all these capital into the venture funds. During the 1980s, the late 1980s, venture capital, it also expanded to other industries. So far, we've been talking about only technology companies, right? Semiconductor companies, hardware companies, and computer manufacturing companies, and software companies like Microsoft. But during the late 1980s, the business of venture capital, it also started looking at other industries, other business industries, industries like biotechnology, for developing new drugs or manufacturing medical devices, which is again requires a lot of upfront capital. Similarly, for retail and consumer companies, also saw a lot of activity in the venture ecosystem. Now, finally, we are in 1990, which is, if you remember, is the time when internet revolution happened. So 1990s, they brought the most dramatic transformation in venture capital history because of the introduction of internet as a commercial platform and a huge commercial platform in itself. And after this time, venture capital was finally an established component of the global economy. The early 1990s, that was a difficult period for the venture capital because of the recession and the poor return from the inflated 1980s investment. As we were talking about, a lot of funds started pooling into the venture funds and the valuations of the company went over the roof, and a lot of investment deals were done above their valuations, and which saw a lot of poor returns. So because of that, the early part of the 1990s were not that good for the venture capital ecosystem, and which caused a significant contraction of the industry, of the venture capital industry. A lot of venture firms, they struggled to raise new funds, and whatever funds they could raise, it was smaller than the previous amounts, smaller than the funds that they were able to raise in the last decade during the 1980s. But finally, with the introduction of World Wide Web, the internet as we know it today, which is around the time, the mid 1990s, with the whole ARPANET, Team Berners-Lee, that again has a different and a big long history, but we'll not get into that. We'll just say that during the mid 1990s, the internet was introduced to the world in the form of World Wide Web, which again created a lot of investment opportunities. Now, one thing which changed in this era, in this particular wave of internet, was all these internet companies, they could potentially reach global markets from the moment they launch, because it is an internet company. All the companies that we've been talking so far, they had a physical existence. They had to reach global markets physically. They had to expand physically. But with the emergence of the internet companies, that whole limitation was suddenly gone. And the marginal cost of serving additional customers, new customers, it was almost close to zero. Marginal cost basically means if you have 100 users, 100 customers, how much cost do you have to incur? How much cost do you have to take on yourself to add one more customer to your user base, to your customer base? That is called as marginal cost. The cost of adding one more unit to your customer base, to your user base. So with the emergence of internet companies, the marginal cost almost went to zero. It's having 100 users was almost as same as adding 10 more users and your user base becoming 110, right? That is not the same for physical markets, which meant that successful companies, they could scale globally and they could scale very quickly from the day one if they have a good enough product, of course. And one of the first example of this we see is with the company Netscape. Netscape, which was a web browser, since it was an internet boom, the introduction of internet to the world, the browser company Netscape, its initial public offering, also called as an IPO, which happened in 1995, that marked as the beginning of the internet boom, at least in the venture capital ecosystem. This company Netscape, it went public in less than 2 years after its founding, and it achieved a market value of 3 billions. So imagine a company in 1995 going public in 2 years with a market valuation of $3 billion. That's first day of trading. We cannot even imagine a company like that even in this time. That's why I know it as an internet boom, the mark of an era, the mark of an internet revolution. Similarly, other internet companies like Yahoo, Amazon, and eBay, they also showed up. They also made a lot of profit. More and more investor money just started pooling into the ecosystem, into the startup ecosystem and into the venture capital ecosystem, which brings us to the crash. Of course, if we are growing this fast, then we have to crash at some point. That crash happened during the 2000 and 2001, which we known as the collapse of internet stock valuations, and which was officially the end of the first internet boom that we know as today. And during this time, many of the venture funds that had invested heavily in internet companies at peak valuations, because of course it was a bull market and it was the internet boom and a new start of a new era and a lot of factors coming in. All the venture funds, they had invested pretty much only in the internet companies, and that also in peak valuations. So they suffered a lot of losses. Of course, the limited partners, LPs, which we call them. LPs are basically the wealthy people, the institutional investors, from which the VC, the venture capitalists, take money and they invest in multiple startups. So LPs, because it was their money, they started becoming more cautious about committing capital to venture funds, about giving their money to these VC companies. The total amount of capital invested in the venture capital industry, that fell from $100 billion in 2000 to $20 billion in 2002. In 2 years, it went down from 100 to $20 billion to $20 billion. But the crash, this whole internet boom and the internet.com crash that happened, this crash helped eliminate a lot of the components, a lot of the unwanted components. People, venture capitalists and limited partners, the LPs, they started having more discipline into the way they invested, into the they researched. So things like due diligence, doing comprehensive market research, comprehensive financial research about the companies that you're investing in, about the VCs that you're investing in, that started becoming the standard. Then after the dot-com crash, of course, the economy, the venture capital business, it all started recovering. So during the period 2000 to 2010, we also saw the emergence of a lot of internet platform companies, and those companies are one of the biggest companies that we have today. Some of them are social media companies like Facebook, Twitter, LinkedIn. They were the companies that proved that internet companies can create value not just through commerce like companies like Amazon, but also by facilitating connections between people, by creating networks, by benefiting from network effects. Similarly, mobile technology, it again created another wave of venture capital opportunities. For example, things like introduction of smartphones, particularly the introduction of iPhone in the year 2007 7. This again created entirely new categories of applications and services. Companies like Uber, Airbnb, Instagram, they built massive businesses around mobile first experiences. These companies also showed us a new phenomenon which is known as winner takes most markets, which basically means that in many internet company categories, a single company would capture the majority of the market value. For example, if you look at social media during the time of 2010 or 2010 to 2020, if someone said social media, then the first company that will come to your mind was Facebook. Then after that, Twitter, LinkedIn, that followed through. But that's it, right? In a world with billions of population, the term social media, the internet company category called social media, was only associated with a few companies, like 3 or 4 companies max. So that's what we call as a winner takes most markets, which also means that these venture capital investors, they needed to identify and they needed to finance these potential category winners, these winners. So they needed to find the Facebooks, the Twitters, and the LinkedIns, the Instagrams of every single category to actually make some amount of profit, to actually gain something out of that deal, which of course creates a lot of pressure on you as a VC, as a venture capitalist. Now, so far we've been talking only about the US. Of course, during the same time, a lot of innovations were happening in the venture capital business, in the venture capital ecosystem in other countries also. For example, if you take China developed the largest venture capital market outside the United States, as we know today. So Chinese venture firms, they financed companies like Alibaba, Tencent, Baidu, all these famous companies that we know today. And those companies, they eventually became the global technology leaders in China and beyond China. So which proved that venture capital was not limited to US markets, US culture, and US location specific. Venture capitalism could thrive in different regulatory environments and different cultural environments. Similarly, if we take a look at Europe, a lot of strong venture capital ecosystem was developed in hotspots, prime locations like London, Berlin, Stockholm, and a lot of other cities. A lot of European companies also started emerging, companies like Spotify, Skype, SAP, right? Also dominating global markets. Same way, Israel also started getting known as the startup nation because all its innovations, all its research in cybersecurity, military technology, and in that area. Similarly, if you come to India, India became a major market for the venture capital industry, particularly when we are talking about software and services companies, which were meant to serve both domestic and international markets. So companies like Infosys and Flipkart, they showed the potential of venture-backed companies in emerging markets. So this whole globalization of venture capitalism industry, it created a lot of opportunities for venture investors to find promising companies, not just in a single country, but across different countries, different cultures and regulatory environments. It also created a lot of challenges around understanding the local markets and regulations and business practices, laws, tax rules, etc., etc. But many venture firms, they began establishing international offices and partnerships to target a specific country, a specific city, to understand its business laws, rules, locality, culture, etc., and to dominate that market. Finally, we come to the current era. That's enough history about venture capitalism, current era, 2025 that you're talking about. Now, today's venture capital industry, this would be barely recognizable to the wealthy individuals that we talked about in the first part of the video, the whaling industry, right? Because the practices, the operations, the culture of venture capitalism, it, even though a lot of things, a lot of philosophies have stayed the same, but the procedures, the practices, they have completely changed. The moment that I am making this video, artificial intelligence, AI, and machine learning, they represent the current frontier for venture investments. Companies like OpenAI, Anthropic, we see 100 new company names every day in the news, at least in the investment ecosystem, which are building for this AI technology. Similarly, climate technology. This is also another major focus for the venture firms. Climate tech basically means companies that develop renewable energy storage, carbon capture, and sustainable materials, etc. Companies which are working in those domains, they are called climate tech. Is trying to fix our climate change problem basically. Similarly, biotechnology. Biotechnology, it continues to evolve with new approaches like gene therapy, personalized medicine, and synthetic biology, which again creates a lot of opportunities for venture capitalism. The COVID-19 pandemic, it showed that how quickly biotechnology companies can develop solutions for global problems. Then fintech. Now, fintech has disrupted the traditional financial services with venture backed companies providing services like digital payments, lending, insurance, investment services. And these companies have shown that even in heavily regulated industries, by heavily regulated, I mean if you want to build a company in finance which deals with money, investment, wealth, insurance, etc., then you have to be an expert in your countries, in your states, laws and regulations that the government has put on for the sake of investors, for the sake of general public, etc., etc. So you have to have a team of lawyers and investment bankers, etc. Like you need a lot of knowledge, a lot of resources to understand and to navigate through all these regulations. So even in heavily regulated industries like finance, a lot of companies have emerged and they have won also. They have become unicorns now. These are some of the prime industries that we frequently see today, that we frequently talk about today. So what are the key lessons that we learn from the history of venture capital? The first thing is the cycles are inevitable. Every generation of venture capitalists has experienced both booms and busts. The success during boom periods does not really guarantee survival during the downturns. You need discipline during the difficult periods, which will create the foundation for your future. The second thing is the technology creates opportunities. There is no denying that. But the execution is what matters. The execution determines your success. Many of the breakthrough technologies, they create opportunities for multiple companies, but only a few will capture the majority of the value. And it will always be like that. So venture capital works best when it can identify not just the promising technologies, but also the promising teams, the teams who are capable of taking a technology and executing on top of it and actually winning. Next is networks and relationships matter more than any other thing that we can talk about, even more than the money. Because the most successful venture investors throughout history, if you look at it, they have built strong network of entrepreneurs, other investors and industry experts. That's what enabled them to win in the ecosystem, enabled them to thrive in the ecosystem, because these networks, they provide you with things like deal flows, due diligence insights, and ongoing support for your portfolio companies. Without these three things, does not matter how large of a fund you could raise, you are not going to survive for long. Next is specialization and generalization. Both have their advantages. Some of the most successful ventures, if you look at it, some of the most successful venture investors, they have focused deeply on specific technologies and specific industries, while there are also other venture investors who have maintained a broader perspective, broader domains, and they have been able to identify opportunities across multiple sectors, and they have won with that strategy. So both of them work. So you need to find out which works for you, how you can distribute your energy. Next is risks and returns are always linked. If you try to reduce the risk without accepting lower returns, you are going to fail. The whole industry of investment or venture capitalism, this works because investors are willing to accept high failure rates in exchange for occasional and enormous success. So failure is the thing that you're going to see more of as compared to your successful ventures. And the last thing is innovation happens pretty much everywhere, but the ecosystems matter more. The breakthrough companies, they can show up pretty much everywhere, but they are more likely to succeed in environments that provide access to things like talent, capital, and expertise. And this is one of the the prime reasons of the success of Silicon Valley, and why companies in Silicon Valley show such huge numbers in profit, in IPOs, in valuations, etc. Because they have the right balance of global talent and capital. A lot of venture capital firms are there. Also, education, Stanford University, a lot of graduates coming out from Stanford University, and the market expertise. A lot of experts, angel investors, and VCs, and investment bankers, and a lot of other professionals, advisors, and experts are there to help you throughout your journey. And the reason we, in the first video of this series, we talked about the history of venture capitalism is because understanding this history helps explain why venture capital works the way it does. And it provides context for how it might evolve in the future also. The specific technologies and the market opportunities will obviously keep changing, but the fundamental challenge of identifying and supporting innovation, that will always remain constant. So the story of venture capital is ultimately the story of people and them willing to bet on other people's innovations and uncertain futures and uncertain markets. It's a story that began with whaling ships, and it continues today with artificial intelligence and space exploration with companies like SpaceX and other attempts. From the next video on, we are actually going to get into the whole ecosystem of venture capitalism.